Imagine walking into a retail store with $20,000 in cash,
Right.
or, the equivalent in rupees, and you are completely ready to buy a product that is sitting right there, literally right in the display case.
You can see it.
You can see it, and the person behind the counter looks at you, smiles very politely, and tells you no.
Yep.
And it's not because the item is reserved,
Yep.
and it's not because your money is fake. It's simply because you haven't earned the right to buy it yet. You don't have the purchase history. You aren't on the list.
It's wild, right? It completely breaks the fundamental rule of standard retail.
Right, which is that capital equals access.
Exactly. I mean, in normal retail, if you have the money, you get the good. But in this specific world, capital is really just the baseline requirement just to walk through the door. The real currency is reputation. It's relationships. It's a proven track record of loyalty to the brand.
And that is exactly what makes today's deep dive so incredibly fascinating. For those of you joining us, welcome. Our mission today is to explore the business of luxury and status in one of the fastest growing emerging markets on the planet.
It's a great topic.
It really is. We are putting a magnifying glass on Ethos Limited. The ticker symbol is ETHOSLTD, and they are India's largest retailer of luxury and premium watches.
And we have a really extensive stack of source material to work through today for this deep dive.
We do.
We're going to be dissecting their recent financial reports, doing a highly granular breakdown of their business model, looking at their unit economic data, and really critically evaluating the risk assessments. Because they manage an incredibly complex operation across over 80 physical boutiques in 26 Indian cities.
But the thing you have to keep in mind as we go through this, and this is a product category that is, objectively speaking, technologically obsolete. Right, like if you want utility, you just buy a new smartphone. It has atomic precision, it syncs to global satellite networks automatically, it adjusts for leap years, and it does all of that as a free background feature.
Yeah, your phone is mathematically perfect.
Exactly. Meanwhile, a mechanical watch is demonstrably less accurate. It requires manual winding or, the physical movement of your wrist just to stay alive. It needs incredibly expensive servicing every few years.
And yet people are willingly, eagerly paying millions of rupees for them.
They are begging to be allowed to buy them.
Because you're looking at the ultimate inversion of functional logic here. With a standard consumer good, demand drops as the price rises. That's just basic economics.
Right.
But with a Veblen good, which is exactly what a high-end mechanical watch is, the demand increases as the price increases. Because the high price is the point. You aren't buying a tool to tell time. You are buying a highly visible, wearable monument to your own success.
The exclusivity is the actual product being sold. The gears and the springs are just the physical medium for that exclusivity.
That's a perfect way to phrase it.
So if you're listening to this, you're probably someone who wants to get smart fast. You don't want the corporate PR spin. You want to look under the hood. You want to open the ledger, look at the unit economics, and understand how this machine actually makes money.
And Ethos is generating 12.52 billion rupees in FY 2025 sales, purely from trading these high-end timepieces and accessories.
12.52 billion. It's staggering. But to really wrap your head around Ethos, you have to completely discard the idea that they are just a shop.
Right. If you analyze them as a traditional retailer, the valuation multiples just won't make sense.
None of it will make sense. Ethos isn't a store. Ethos is a gatekeeper of aspiration. They are the toll booth on the highway for India's rapidly expanding upper middle class. Think about it. When someone finally makes it in India, when they get that massive corporate promotion where they sell their tech startup, Ethos is standing there, holding the velvet rope, ready to sell them the physical manifestation of that achievement.
I love that analogy, gatekeeper of aspiration. Yeah. Because what Ethos is actually monetizing isn't the metal or the glass. They are monetizing trust, curation, and access.
Right.
But before we can dissect how their specific economic engine works, we really have to map out the terrain they are operating in. We need to size up the Indian luxury watch market to understand the sheer scale of the demographic shift happening right now.
Let's do it. Because the numbers and the sources regarding their market share are pretty wild if you understand physical retail. Ethos holds a 13% share of India's overall premium and luxury watch retail sales.
Which is huge.
It is. In a fragmented physical retail environment, 13% is a massive footprint. But then, when you zoom in on what the sources call the exclusive luxury segment, their market share skyrockets. It goes up to between 35 and 40%.
Yeah, in that specific ultra-high-end arena, they are the undisputed heavyweight champion. There's really no one else close.
So let's define the ceiling of this market. What is the total addressable market, or the TAM?
According to the sources, the organized premium and luxury watch TAM in India is currently estimated to be between 8,000 and 12,000 crore rupees annually.
Okay, for context for our listeners, 1 crore is 10 million rupees. So we're talking about 80 to 120 billion rupees flowing through legitimate, organized retail channels every year.
Exactly. And that number is compounding quickly due to the underlying macroeconomic tailwinds.
So let's break this massive market down, because the sources divide it into 4 very distinct tiers. And I think it's crucial we walk through them because the psychology of the buyer and, honestly, the margin profile for Ethos changes dramatically at each step.
Let's start at the bottom. The entry point is the premium segment.
Right. These are watches priced roughly between 1 and 5 lakh rupees, so 100,000 to 500,000 rupees. We're talking about brands like Longines or Oris.
This is the I just got my first big bonus watch. Or maybe the traditional wedding gift for a young professional.
It's accessible aspiration.
Yes, exactly. Yeah. The buyer in the premium segment is usually making their first real foray into Swiss horology. They are buying into the heritage and the brand name. But then you step up to the second tier, which the industry designates as bridge to luxury.
Bridge to luxury. So this is where you find brands like Tag Heuer or Rado. The pricing here is transitional.
Right. You are moving past the entry-level corporate bonus territory, but you aren't quite dropping the equivalent of a luxury car down payment on a single timepiece.
Right. It's an upgrade, like someone entering middle management or, establishing a successful professional practice.
Yep. And then we hit the third tier, which is the luxury watch category. This is the core of the high-end market. Omega, Breitling, IWC Schaffhausen.
Okay, so this is where you are making a serious, undeniable statement about your financial status.
Oh, absolutely. You are buying complex in-house mechanical movements, profound brand histories, and serious social signaling.
But even that isn't the top.
No, it's not.
The fourth tier is the high luxury segment. We are talking watches priced above 10 lakh rupees, and often extending into the tens of millions. Hublot, Jacob & Co., Bvlgari, H. Moser & C.
These are watches that literally cost as much as a luxury apartment.
It's just staggering. But the truly fascinating element here is the macroeconomic engine that is driving growth across all 4 of these tiers simultaneously.
It really is. India is undergoing a demographic and economic transformation that is virtually unprecedented in modern history. The projections from our sources indicate that 350 to 400 million people will enter the middle and upper middle class by the year 2030.
Let that sink in. 350 to 400 million people. That's the equivalent of taking the entire population of the United States and spontaneously dropping them into a higher income bracket, all within a single decade.
It completely redefines the consumer landscape. And then you have to add the velocity of urbanization to that equation.
Right, people moving to the cities.
Exactly. India's urban population was around 30% in 2010. It's currently hovering around 40%, and it's projected to cross 50% soon. This mass migration concentrates affluence in major metros and Tier 1 and Tier 2 cities.
Which is exactly what creates those dense pockets of wealth that make high-end physical retail viable in the first place.
Precisely. Furthermore, and perhaps most critically for the top 2 tiers of the watch market, the population of high-net-worth individuals, HNIs, is growing at a 12% compound annual growth rate.
12% AGGR for high-net-worth individuals? That's massive. And this wealth isn't just growing, it's formalizing.
That concept, wealth formalization, is crucial here.
Yeah, let's unpack that. People are moving their assets out of the shadows, right? Out of informal or unrecorded cash channels and bringing their money into the formal, taxable economy.
Because when your wealth is formalized, you can spend it visibly without attracting unwanted regulatory scrutiny. You can walk into a store in a brightly lit mall and swipe a credit card for a 20 lakh rupee watch without worrying about an audit.
But this brings up a massive issue highlighted in the source material. And it's kind of the elephant in the room. The market outside of Ethos is a chaotic mess.
Oh, it is deeply fragmented and historically plagued by illicit channels.
The sources state that a staggering 40 to 60% of the total watch market in India consists of smuggled goods or outright fakes.
Nearly half the market.
Right. So let me play devil's advocate here for a second. Because if I'm looking at a business where half the total addressable market is flooded with black market alternatives, I'm incredibly skeptical.
Sure.
Why would a rational consumer walk into an Ethos boutique, pay full retail price, plus an 18% goods and services tax, when they could just go to an unauthorized dealer in a gray market bazaar and buy the exact same watch smuggled in without import duties for 20 or 30% less?
That's a fair question.
Or worse, why wouldn't they just buy a super clone fake that looks identical to 99% of the population for a fraction of the cost? I mean, if status is just about what other people think, doesn't a good fake do the exact same job?
It's a fundamental question that challenges the entire premise of luxury retail. But to answer it, we really have to dissect the psychology of a high net worth individual. First, let's address the gray market. So, the authentic but smuggled watches.
Okay, the real watches that just bypassed customs.
Right. When you are buying a complex mechanical device containing hundreds of microscopic gears that require specialized lubrication and calibration, the international warranty is paramount.
Right.
If you buy a smuggled Omega and the coaxial escapement fails in 6 months, you cannot take it to an authorized service center. They won't touch it. You are entirely on your own, trusting some local repairman with a 20 lakh rupee investment.
Oh, wow. So the risk of catastrophic failure essentially outweighs the 20% upfront discount.
For a wealthy buyer, yes, absolutely. The financial pain of a broken, unserviceable watch is actually secondary to the sheer frustration and embarrassment of the situation. They just want it to work, and if it breaks, they want VIP treatment to fix it.
That makes sense. Okay, now what about the fakes? The super clones?
Right. Regarding your point about super clones and fakes, this touches on the core psychology of the Vvlgari good. You argued that if 99% of people can't tell the difference, the fake achieves the goal.
Yeah.
But the high net worth individual isn't wearing an H-Moser to impress the 99%. They are wearing it to signal to the 1% who actually do know the difference.
Ah, the peer group.
Exactly. The boardroom, the exclusive country club, the private equity meeting. If you are sitting across from a billionaire who owns a genuine collection, and they spot that your tourbillon cage is slightly off-axis, or the finishing on the hands lacks the requisite anglage, your entire reputation is instantly compromised.
You're completely exposed.
The dread of being found out by a peer completely negates any perceived value of a counterfeit. And furthermore, there's the internal psychological reality.
What do you mean?
The wearer knows it's fake. You cannot derive the internal satisfaction of having made it when you know the ultimate symbol of your success is a lie.
That is fascinating. That makes perfect sense. So in a market completely saturated with counterfeits and shady gray market dealers, absolute, undeniable authenticity becomes your primary product.
Yes.
Ethos isn't just selling the watch. They are monetizing the peace of mind. They are selling the antidote to the anxiety of the gray market.
And when you look at the penetration metrics, you realize how early we are in this transition from unorganized to organized retail in India.
What do the numbers look like?
India's per capita luxury spend is currently hovering around $10 to $15. Contrast that with the global average, which is well over $100.
Wow, $10 versus $100.
The runway for growth is immense. Ethos is currently leaving 60 to 70% of the organized TAM wide open. And that doesn't even factor in the massive wave of consumers who will inevitably migrate from the unorganized gray market to the trusted retail space as their wealth formalizes.
Because they are going to demand the security of authorized channels once they have legitimate taxable wealth to spend. So the sheer chaos of the broader market is actually the catalyst that makes a trusted player like Ethos absolutely necessary.
It creates the demand for their specific model.
Which brings us to the most critical question for any investor or business analyst looking at this company. If the opportunity is this massive and the macroeconomic tailwinds are this strong, why hasn't someone else just copied their playbook?
It's the moat question.
Right. We need to aggressively interrogate their moat, their defense mechanisms. Because in retail, success usually breeds immediate, ruthless competition.
To understand the depth of their moat, we must first comprehend the sheer scale and complexity of their current operations. Because Ethos isn't merely carrying a curated selection of a dozen popular watches.
What are they carrying?
They retail over 70 different luxury watch brands. And they maintain an active inventory of more than 5,000 distinct SKUs or stock-keeping units.
5,000 different luxury watches. That is an astronomical amount of high-value capital just sitting under glass across the country.
It is.
But the inventory itself isn't the moat, right? I mean, anyone with a massive line of credit could theoretically buy 5,000 watches. The actual defense mechanism is what the sources call their brand advantage.
Correct. Ethos is the exclusive authorized retailer for many of these brands. They hold the brand warranties, and they provide the Ethos stamp of assurance.
So explain why a competitor can't just get that same authorization.
This requires a deep dive into the history and culture of the Swiss luxury watch industry. The global landscape is dominated by massive conglomerates, Richemont, Swatch Group, LVMH, alongside fiercely independent titans like Rolex and Patek Philippe.
Okay.
These entities do not operate like normal consumer goods companies. They do not care about maximizing short-term quarterly sales if it means risking even a fraction of their long-term brand equity. They have spent, in some cases, over a century cultivating an aura of extreme exclusivity and prestige.
So you can't just rent a storefront in a high-end mall in Mumbai, prove you have $10 million in the bank, and call up Geneva to order a shipment of Royal Oaks or Speedmasters.
They would literally laugh you off the phone. The authorization process is notoriously draconian. The Swiss brands require their retail partners to demonstrate years of proven, unimpeachable trust. They demand a flawless track record of customer service.
It's a relationship game.
Heavily. But beyond reputation, they demand heavy, capital-intensive infrastructure. If a brand allows you to sell their watches, they dictate everything.
Like what?
They will dictate the exact color temperature of the lighting in your display cases. They will dictate the thickness of the glass, the specific architectural layout of the boutique, the training curriculum of the salesperson holding the tray, even the biometric security specifications of the vault where the inventory sleeps at night.
That is insane. It sounds like setting up an embassy rather than a retail store.
It's very similar.
So the Ethos stamp of assurance is essentially a diplomatic passport. It grants them safe passage in a country notorious for counterfeits because the Swiss brands are publicly granting them diplomatic immunity, essentially telling the Indian consumer, these guys are our official representatives.
That level of trust creates a brutal chicken and egg problem for any new entrant.
How so?
To build a reputation in the luxury watch space, you need the top-tier brands in your cases. But to get the top-tier brands to authorize you, you already need a pristine, decades-long reputation.
Right. And Ethos has spent 20 years building those relationships.
A new competitor faces an almost insurmountable barrier to entry regarding brand acquisition.
And even if a competitor somehow convinced a few brands to take a chance on them, they run face first into the second layer of Ethos's defense. The sources call this the distribution advantage.
The physical footprint.
Yeah, Ethos operates an extensive physical footprint of 63 to 80 boutiques across 24 to 26 major cities. And they aren't just in the obvious wealth centers like South Mumbai or Central Delhi. They have operations stretching from their headquarters in Gurugram all the way to cities like Chandigarh, capturing regional wealth.
This represents the capital expenditure, or CapEx, barrier. Securing prime retail real estate in Tier 1 and Tier 2 Indian cities is extraordinarily expensive. We are talking about high street locations and ground floor anchor spots in premium luxury malls.
You can't just put a luxury watch store in a strip mall.
Exactly. The fit-outs require imported marble, custom millwork, and bank-level security systems. A new competitor attempting to build out a comparable pan-India physical presence would have to burn through billions of rupees in upfront capital, enduring years of negative cash flow before they even achieved a fraction of Ethos's scale.
But the moat goes even deeper than real estate, right? The sources highlight an ecosystem advantage.
Yes.
This is about capturing the life cycle of the consumer after the initial sale. Ethos has built state-of-the-art service centers equipped with specialized machinery imported directly from Switzerland. They employ actual horological engineers, not just, battery replacers, and they tie it all together with their Club Eco loyalty program.
The post-sale ecosystem is entirely non-negotiable in high horology because a mechanical watch is a living machine.
Right. It has moving parts.
Hundreds of them. The synthetic oils inside the escapement eventually dry up. The mainspring loses tension. The movement requires complete disassembly, ultrasonic cleaning, relubrication, and microscopic calibration every 5 to 7 years.
Wow.
If you buy a complex perpetual calendar mechanism, you absolutely require specialized brand-certified facilities to maintain it. Fragmented, unorganized competitors completely lack the scale and the capital to build a nationwide service network staffed by Swiss-trained engineers. Ethos employs an army of 780 heavily trained personnel to ensure the client never has to leave their ecosystem.
Okay, the physical moat is clearly massive. The brand relationships, the real estate, the service centers. But I have a serious concern here.
Let's hear it.
The source material explicitly states, in plain language, that Ethos has no cost advantage and no technology advantage. I need to push back on this heavily. In the modern business landscape, if you lack a structural cost advantage and you aren't leveraging proprietary technology to outmaneuver your rivals, you are usually a sitting duck. Look at every other retail sector: electronics, fashion, books. A digital-first disruptor comes in, sets up a massive centralized warehouse outside the city, drops prices by 15% because they have zero physical storefront overhead, and completely destroys the incumbent margins. Why couldn't an aggressively funded online-only player do exactly that to Ethos?
It is a completely valid fear if you are analyzing a traditional retail business. But luxury operates on an entirely inverted set of economic laws. The lack of a cost advantage isn't a vulnerability. It is a legally enforced feature of the authorized dealer model.
Wait, really?
Yes. Remember, Ethos is selling a Veblen good. The Swiss brands strictly and ruthlessly dictate pricing floors to prevent a race to the bottom that would inevitably destroy their brand equity.
So they aren't allowed to compete on price?
Precisely. If a well-funded digital disruptor entered the Indian market and decided to sell a Breitling Navid timer for 20% below the mandated retail price to capture market share, the Swiss brand would instantly intervene.
What would they do?
They would revoke the disruptor's authorized dealer status, cut off their supply chain overnight, and likely pursue legal action for breach of contract. And the moment that disruptor loses their authorized status, they are banished back to the gray market, which, as we established earlier, the high net worth target consumer actively avoids.
That is wild. The brands themselves enforce the price floor, essentially creating a legal cartel that protects the retailer's gross margins.
That's exactly what it is.
So the disruptor can't undercut Ethos because price competition is literally a violation of the supply contract.
And addressing the technology piece. While Ethos certainly utilizes modern CRM software and complex inventory management systems to track those 5,000 SKUs, their true defensible advantage is inherently physical, relational, and experiential.
Because of the feeling of buying it?
Exactly. You cannot code a digital substitute for the psychological impact of a trained horologist handing a client an espresso, seating them in a private viewing room, and placing a solid rose gold timepiece on their wrist. The moat is built on high-touch, capital-intensive physical infrastructure that software simply cannot replicate.
So since they are structurally protected from price wars, their internal financial mechanics must be uniquely calibrated to take advantage of this setup. We need to open the ledger. Let's look at the unit economics and figure out how they actually turn these expensive Swiss mechanisms into corporate profit.
Let's dig into the financial reality of selling time.
The top-line revenue growth is the first indicator of their successful execution. In fiscal year 2021, their revenue stood at 3.87 billion rupees. Fast forward to the projections for FY 2025, and they are generating 12.52 billion rupees.
We're looking at a compound annual growth rate, or CAGR, of roughly 33%, and that is driven almost entirely by the aggressive expansion of their physical boutique network.
Tripling revenue in a 4-year window in physical retail is phenomenal. And looking at the gross margins, they are structurally anchored between 25 and 35%.
Let's clarify that for anyone unfamiliar with retail accounting. Gross margin represents what the company keeps after subtracting the direct wholesale cost of the watch itself.
Right. So if Ethos sells a timepiece for 1 lakh rupees, they retain roughly 25 to 35,000 rupees to cover the rest of their business operations.
Correct. Those gross margins reflect the substantial markups inherent in luxury retail, often 2 to 3 times the wholesale cost, which are protected by those exclusive brand agreements we discussed.
But that money isn't all profit.
Not at all. That seemingly healthy gross profit is immediately subjected to incredibly heavy operating costs. They are paying premium commercial rents for those high street and anchor mall locations. They are covering the payroll for 780 highly specialized trained employees. They are amortizing the massive capex required for the boutique fit-outs, the security vaults, and the imported service machinery.
Which makes their capital efficiency metrics incredibly interesting to unpack, because Ethos is currently operating entirely debt-free. Their total debt sits at 0.
That's a crucial point. zero debt in a high capex business.
Meanwhile, their return on capital employed, or ROCE, is 13.8%, and their return on equity, ROE, is hovering around 10 to 11%.
Let's break down why those specific metrics are so vital for a capital-heavy business like this. ROCE, return on capital employed, is essentially the ultimate test of management's ability to allocate resources.
How so?
Well, if Ethos takes 100 rupees and sinks it into a physical asset buying marble for a storefront, installing a biometric vault, or purchasing inventory to sit in the display case, ROCE tells us how much operating profit that 100 rupees generates in a year.
So at 13.8%, for every 100 rupees they tie up in the business, they're generating almost 14 rupees of profit annually. In the context of capital-intensive retail, where you are front-loading massive expenses before making a single sale, generating a nearly 14% return without utilizing debt leverage is a testament to strong operational discipline.
But the real magic of their financial model, the mechanism that allowed them to achieve a staggering 120% profit CAGR over a recent 5-year period, is operating leverage. We have to dissect how fixed versus variable costs function in luxury retail to understand this.
Okay, walk me through the P&L of a single boutique. Let's say they open a new store in Chandigarh.
Sure. When Ethos opens that boutique in Chandigarh, roughly 60 to 70% of their ongoing costs are entirely fixed.
Meaning they don't change based on sales.
Right. The premium rent they pay to the mall developer does not fluctuate whether they sell 1 watch that month or 50 watches. The salaries of the security guards, the lighting bills, the base pay for the horologist, it is all a fixed burn rate. Therefore, at low initial sales volumes, a luxury boutique bleeds cash heavily. Every transaction is just chipping away at that massive fixed overhead.
But there is a tipping point.
The break-even point. Once that boutique sells enough inventory to fully cover the rent, the payroll, and the utilities for the month, the underlying economics completely flip.
Because the fixed costs are already satisfied.
Exactly. The gross margin from every subsequent watch sold drops almost entirely to the bottom line as pure operating profit.
That is the essence of operating leverage. As Ethos scaled its overall revenue from $3.8 billion to $12.5 billion, they didn't have to triple their rent because the stores were already built. They didn't have to triple their payroll.
Right. A 10% increase in top-line revenue might mathematically trigger a 20 or 30% increase in EBITDA earnings before interest, taxes, depreciation, and amortization because the incremental sales are so highly profitable.
That is the compounding engine. However, there is a metric in the source material that demands extreme scrutiny. The inventory reality.
Ah, the inventory days.
Ethos operates with extremely high inventory days. Specifically, the data shows 246.76 days. This means that, on average, from the moment Ethos purchases a watch from Switzerland to the moment a customer walks out of the store with it, that watch sits in their possession for over 8 months.
It's a long time.
They have between 3 and 5 billion rupees in working capital, entirely tied up in physical stock at any given moment.
Which sounds terrifying to a traditional retail analyst.
It does. If you look at standard retail, say, a fast fashion brand like Zara or a grocery chain, 8 months of unsold inventory is a death sentence. It means your goods are spoiling or the fashion trends have moved on and you are facing imminent bankruptcy. I have to imagine this massive inventory overhang is a huge risk.
But you cannot apply fast fashion mechanics to high horology. Omega Speedmaster does not spoil. The aesthetic appeal of a classic mechanical timepiece does not evaporate in 8 months. In fact, in many cases, certain models actually appreciate in desirability over time. The high inventory days metric isn't a failure of supply chain management. It is a structural necessity of their business model.
It sounds to me like they aren't running a traditional retail store at all. They are running a high-end museum where everything just happens to be for sale eventually. You have to have the exhibits on display.
That is an incredibly accurate way to conceptualize it. The museum analogy is perfect. Remember, they are offering over 5,000 distinct SKUs.
Right.
The high-net-worth consumer is exceptionally demanding. If a client walks into an Ethos boutique in Mumbai specifically looking for a Panerai Luminor with a particular dial configuration, and the salesperson says, "We don't have it in the case, but we can order it from Switzerland. It will be here in 3 weeks," that client will likely walk out the door.
Because the impulse to consume luxury is immediate.
You must have the depth and breadth of assortment physically present to capture the sale in the moment. Tying up billions of rupees in inventory is simply the mandatory cost of entry to operate at this level.
Okay, I understand the necessity of the inventory, but what does this mean for the actual cash flow of the business? I'm looking at the numbers, and as we established, they have zero debt, which is incredibly rare and positive, but their cash flows are highly volatile.
They are.
The sources indicate they had a negative 20 crore net cash flow in FY 2025. How do you reconcile record-breaking revenues of 12.5 billion, highly profitable operating leverage, zero debt, but ending the year having bled 20 crore in cash?
The negative cash flow is not a sign of operational distress. It is a direct reflection of aggressive, deliberate reinvestment.
Okay, walk me through that.
They are taking all of the operational cash generated by their mature boutiques and immediately sinking it into capital expenditure CapEx. They are building new boutiques in new cities, which requires massive upfront build-out costs, and they are purchasing the initial 8-month inventory load required to fill those new display cases.
So they are basically in pure land grab mode. They are a cash-eating machine right now because they are racing to capture market share before competitors can establish a foothold.
Exactly. Because they carry zero debt, they are funding this massive pan-India expansion almost entirely through internal accruals.
But this requires us to ask a critical strategic question. Where is all this capital actually going? A physical market is finite. They cannot rely purely on opening new physical stores forever. They have to prove they can scale the business beyond simple geographic expansion to justify their current valuation multiples.
That pivots us perfectly into analyzing their roadmap for the future. Let's examine their vectors for future growth, because right now the engine is humming, but to maintain a high growth narrative, they have to pull new levers.
The sources outline 4 primary vectors for future growth. The first is the most traditional, and based on their historical execution, the most highly credible: store network growth.
Right, more stores.
They are actively expanding beyond their current footprint of 80 stores. The strategy is to capture that 60 to 70% of the total addressable market that remains unorganized, specifically by moving into underserved Tier 2 and Tier 3 cities.
This makes perfect sense. The wealth in India is no longer confined to South Mumbai, Central Delhi, or the tech corridors of Bangalore.
Exactly. There are massive industrial families, successful agricultural entrepreneurs, and regional business owners in Tier 2 cities who desire luxury status symbols just as intensely as their metropolitan counterparts.
If Ethos can be the first organized, trusted player to open a flagship boutique in these emerging wealth centers, they capture that regional market entirely.
And the historical data proves they can execute this physical expansion efficiently. Their revenue tripled in 5 years, almost directly in tandem with their store additions. But, as we noted, adding physical stores is a linear growth model. It eventually hits a ceiling.
Which is why the second growth vector, premiumization, is so important. This is where they're attempting to structurally expand their margins and capture more value from their existing footprint.
Premiumization. I love this concept. This is the strategy of deliberately shifting the overall sales mix toward the high luxury tier, those watches priced over 10 lakh rupees, while simultaneously introducing high-margin accessories, jewelry, and watch winders.
It's about moving the customer up the value chain.
Think about it like managing the cabin classes on a commercial airline. You have economy, premium economy, business class, and first class. Once you get a passenger comfortable with flying premium economy, your entire marketing goal is to gently nudge them, incentivize them, and upgrade them to business class on their next flight.
Ethos does the exact same thing. Ethos gets the young professional in the door with a 1 lakh rupee Longines. 5 years later, when they get promoted, Ethos guides them into a 5 lakh rupee IWC. 10 years later, they're steering them toward a 20 lakh rupee hublot.
It's an upward mobility funnel.
And the financial impact of premiumization is profound. The fixed operational effort required for a horologist to sell a 1 lakh rupee watch is largely the same as the effort required to sell a 20 lakh rupee watch.
Right. It still takes an hour of consultation, an espresso, and a velvet tray.
Exactly. But the absolute gross margin generated in rupee terms on the high luxury piece is exponentially larger. It drastically improves the profitability per square foot of the boutique without increasing fixed costs.
That's a very powerful margin lever. But the third growth vector outlined in the sources is, from a pure business mechanics perspective, absolutely brilliant. It's their entry into the CPO market-certified pre-owned watches.
It functions as a genius secondary flywheel for the business. Let's walk through the mechanics of how CPO actually operates in their ecosystem.
Yes, explain this, because when I read the unit economics on this, it seemed almost too good to be true.
Imagine a client who bought an Omega from Ethos 3 years ago. That client now wants to upgrade to a higher tier feeding, perfectly into the premiumization strategy we just discussed.
Okay, so they want to trade up.
Ethos will offer to buy back the original Omega. Now, because Ethos possesses the Swiss-imported machinery, the dedicated service centers, and the trained horological engineers, they don't just flip the watch. They thoroughly authenticate it, overhaul the movement, polish the case, and then place it back in their display cases as a certified pre-owned timepiece, backed by an Ethos warranty.
Wait, this means they are capturing the retail margin twice on the exact same physical mechanism.
Exactly. They made a 25% gross margin when they sold it brand new, and now they buy it back below market value, refurbish it, and make another margin when they sell it used.
And the sources suggest the percentage margin on CPO can actually be higher, sometimes 30 to 50%, because they control the buy-in price.
It is highly lucrative. But perhaps more importantly, it reinforces their core brand promise. It's the ultimate defense against the gray market.
How so?
The secondary market for luxury watches has traditionally been the wildest part of the Wild West. It is plagued with Franken watches, pieces assembled from various broken watches containing unauthentic parts. By creating a formalized, trusted, authenticated secondary market within their own ecosystem, Ethos completely eliminates the gray market anxiety for the pre-owned buyer.
They lock both the seller upgrading and the buyer entering the market firmly into the Ethos ecosystem.
It is an incredible self-reinforcing business loop.
But then we hit the fourth growth vector mentioned in the sources, the digital shift. The strategy involves enhancing omnichannel e-commerce capabilities, allowing for seamless transitions between digital browsing and physical boutique purchasing.
E-commerce in luxury.
The sources note that e-commerce already enables 20 to 30% of the sales growth in the broader luxury sector globally. But honestly, I really struggle to visualize this working for ultra-high-end mechanical watches.
Why the skepticism?
Because of the very nature of the product, can you realistically imagine someone sitting on their couch, pulling out their smartphone, scrolling to a 50 lakh rupee Jacob & Co. timepiece, adding it to their digital cart, and clicking checkout with Apple Pay?
Oh.
I mean, if I am spending the equivalent of a suburban house on a piece of jewelry, I demand the tactile experience. I want the velvet gloves. I want to feel the weight of the platinum on my wrist. I want the horologist to personally explain the intricacies of the tourbillon movement. Doesn't heavily investing in digital e-commerce threaten to strip away the exact physical experiential moat we just spent half an hour establishing?
You are identifying a crucial tension in modern luxury retail. But the digital shift isn't about replacing the physical boutique. It's about redefining the customer journey through an omni-channel approach.
Okay, clarify that.
You are correct that the final transaction for a high-luxury 50 lakh rupee piece is highly unlikely to occur via an unassisted smartphone tap. However, the discovery and research phases have moved entirely online.
So the digital platform acts as the top of the funnel.
Precisely. A prospective buyer might spend 3 weeks exploring the Ethos digital catalog. They read detailed articles about the history of the A. Lange and Son movement. They check real-time inventory availability at their local boutique. They might even initiate a WhatsApp conversation with a dedicated digital concierge to discuss specific dial configurations.
So they do all the homework before they even walk in.
Exactly. By the time they physically walk into the boutique, the decision to purchase is essentially 90% complete. The physical visit becomes the ceremonial culmination of a digital journey.
I see.
Or furthermore, for the lower tier segments, the premium or bridge to luxury tiers, or for high-margin accessories like custom leather straps and automated watch winders, frictionless digital transactions are happening.
Because the price point is lower.
Because Ethos attaches their stamp of assurance to the website, they provide the necessary trust to transact online in a market where consumers wouldn't dare buy from an unverified digital storefront.
That tension between digital scalability and the absolute necessity of physical exclusivity is a perfect pivot point for our analysis. Up until now, we've painted a picture of an unstoppable compounding machine. Strong macro tailwinds, an impenetrable moat, brilliant operating leverage, and multiple avenues for growth.
It sounds perfect.
But beneath the sparkling 120% 5-year profit growth narrative, there are some serious cracks starting to appear in the recent financial data.
There really are.
We need to be rigorously objective here. Let's examine the dark side of the ledger. We need to talk about the red flags, the operational risks, and a very complex governance puzzle.
This is where critical financial analysis is required, separating the macro narrative from the micro reality. The most glaring red flag currently flashing in the source material is the severe slowing of their operational momentum.
Let's look at the numbers.
While the company boasts a spectacular 5-year profit CAGR of 120%, if we look closely at the trailing 12-month, or TTM, profit growth, that number has plummeted to a mere 5%.
Wait, dropping from a compounding growth rate of 120% down to 5% isn't just a slowdown, that is hitting a brick wall at highway speeds. What is causing the engine to stall?
We can identify the exact friction points by looking at the Q3 FY26 operational numbers. The company is suffering from significant margin compression. Their operating margins dropped from 15.42% down to 13.11% year over year.
Where exactly did that 2.3% of margin go? Did the Swiss brands force them to lower their retail prices? Did they have to offer discounts to move that massive inventory?
No, the pricing remained completely resilient. The margin compression was entirely driven by an explosion in their internal operational costs. Specifically, the sources highlight a massive 39% spike in employee costs, occurring simultaneously with record-high interest and depreciation expenses associated with their rapid store expansion.
A 39% jump in employee costs in a single period is staggering.
It's massive.
But, it makes sense when you consider their moat. If your entire defense against the gray market and digital disruptors is the quality of your in-store experience, you are entirely reliant on human capital.
Absolutely.
You have to attract and retain highly specialized Swiss-trained horologists and sophisticated luxury sales staff. You cannot replace an expert who understands the intricacies of a perpetual calendar movement with an entry-level retail worker making minimum wage. As inflation rises and the luxury sector expands, the cost of retaining that specialized talent is skyrocketing.
The human capital required to maintain the moat is becoming exponentially more expensive. Now, we must synthesize this reality severe margin compression and stalling profit momentum with the company's current market valuation.
And what is the valuation looking like?
The stock is currently priced for absolute perfection. Depending on the specific trailing metric utilized, Ethos's price-to-earnings, or PE, ratio is sitting between 53 and 74.
Let's contextualize a PE ratio of 74 for a moment. The PE ratio essentially measures how much investors are willing to pay today for one single rupee of the company's current earnings. In the software or high-tech sector, where gross margins are 90% and distribution costs are zero, high PE multiples are common.
Sure, because scaling is basically free.
But Ethos is a physical retail business selling heavy pieces of metal out of expensive marble storefronts. A PE of 74 in physical retail is astronomical. It implies that the market is blindly pricing in flawless exponential growth for years to come.
That is the dangerous cocktail investors are currently holding. The valuation demands continuous exponential scaling, but the recent financial reality reveals a business model that is becoming linear, burdened by escalating human capital costs and heavy depreciation. The financial engine is working significantly harder, burning more fuel just to maintain the same forward speed.
And if you look closely, it seems the people closest to the engine might recognize this discrepancy. This brings us to the governance flags, which are frankly concerning.
Yeah, let's talk about the Spoo family.
Right. The sources explicitly note that the promoter family, the Sabu family, who founded and currently manage the company, have decreased their personal holding by 14.1% over the last 3 years.
In corporate analysis, insider selling is a critical signal. When you combine a sky-high valuation multiple with the founding family significantly reducing their ownership stake, it frequently signals a lack of internal confidence regarding future upside.
They are cashing out.
They are systematically cashing out a substantial portion of their equity, while the public market is still assigning a premium multiple to the stock.
And it doesn't stop there. Despite generating consistent profits and presenting this high-growth narrative, the company pays a 0.00% dividend yield. They are returning absolutely no cash directly to the shareholders who are propping up that massive valuation.
Furthermore, we have to evaluate key person risk. Despite the large retail footprint, the company operates with a very lean corporate structure. They have 780 employees, but there is limited visible executive bench strength beyond the CEO and the founding family.
Which is a problem in a relationship-based business?
Exactly. In the luxury watch industry, where securing brand authorization is entirely dependent on personal relationships and deeply established trust with Swiss conglomerates, this is a glaring vulnerability. If the critical relationships with Rolex, Omega, or Richemont are tightly held by a single family, what happens during a sudden leadership transition? The moat could be significantly shallower than it appears on paper.
And we haven't even touched on the external macroeconomic risks. Ethos is highly cyclical because they are entirely reliant on H&I wealth. And H&I wealth in India is deeply correlated to the performance of the domestic stock market and real estate.
It's all tied together.
If there is a broader economic correction or a massive stock market crash, that formalized wealth evaporates on paper, and suddenly nobody is in the mood to buy a 20 lakh rupee hublot. It's a discretionary purchase that can be delayed indefinitely.
There are also existential threats from within the industry itself. What if the global brands decide they no longer need a middleman?
Right.
As the Indian market matures and infrastructure improves, brands like Omega or IWC might simply decide to bypass Ethos entirely, choosing to open their own exclusive mono-brand boutiques to capture the full retail margin themselves.
They could just cut them out.
Alternatively, what if massive, heavily capitalized conglomerates like the Tata Group or global retail giants like Watches of Switzerland decide they want a piece of the Indian luxury watch market? They have the balance sheets to endure years of operating losses, simply to bleed Ethos out and steal market share.
If Tata enters with endless capital, or if brands start pulling their authorizations to go direct to consumer, that already compressed 13% operating margin would be instantly crushed.
It would be brutal.
But I want to step back and play devil's advocate for a moment, because we are dissecting this very critically, and perhaps we are applying standard corporate logic to a unique founder-led growth story. Let's look at this through the lens of the Cebu family.
Okay, let's look at the other side.
If I am the founder of a fiercely capital-intensive physical retail business, and my primary objective is to capture a once-in-a-generation demographic shift in India's wealth, maybe I shouldn't pay a dividend. Maybe I need to aggressively retain and reinvest every single rupee of operational cash flow to build new stores and acquire new inventory before Tata or Watches of Switzerland can establish a foothold.
Reinvestment over dividends is a historically validated growth strategy. Amazon famously operated for decades without returning cash to shareholders, plowing every cent back into infrastructure to establish an unassailable monopoly.
Exactly. You cannot fund aggressive pan-India capex if you are bleeding cash out to shareholders. And regarding the promoter dilution, the family selling 14% of their stake. Maybe they aren't selling because they think the company is doomed. Maybe they're selling simply to achieve basic personal financial diversification.
That's entirely possible.
If 99% of a founder's net worth is locked up in a single, highly cyclical luxury watch retail company, any competent wealth manager would scream at them to liquidate a portion and diversify into index funds or real estate. Are we being overly cynical by labeling these standard growth and diversification movers as red flags?
It is a vital counter-perspective, and it highlights the nuance required in financial analysis. The lack of a dividend is entirely justifiable and, frankly, mathematically necessary for a company that generated a negative 20 crore free cash flow, precisely because it is pouring capital into aggressive physical expansion. You physically cannot pay a cash dividend using money you've already committed to a 10-year lease and a marble fit-out in a new mall.
Right. It's just impossible.
As for the promoter dilution, personal wealth diversification is completely logical. However, context and timing matter immensely. Selling a 14% stake into a historically high PE ratio of 74 at the exact same moment that operational margins are actively compressing and profit momentum is stalling is what raises alarms for institutional investors.
It's not one single metric. It's the confluence of the data points. It's the whole mosaic.
Precisely. It is the intersection of high valuation, slowing growth, rising costs, and insider selling that warrants severe caution, regardless of the valid justifications for each individual action. Which brings us to the ultimate synthesis of our deep dive today.
When we look at Ethos Limited, we are observing a fascinating high-stakes dichotomy.
We really are.
On one hand, you have an incredibly well-positioned company acting as the sole trusted gatekeeper to one of the world's most lucrative and fastest-growing affluent demographics. They have meticulously constructed an incredibly defensible moat built on exclusive, hard-to-win Swiss brand relationships and a capital-heavy physical infrastructure that is brutally difficult and wildly expensive for any new entrant to replicate.
Yes. And on the other hand, they're operating a severely capital-heavy, inventory-laden business model that is currently slamming into the realities of scale. They are facing acute margin squeezes driven by the rising cost of specialized human capital, a sharp deceleration in top-line profit momentum, and questionable governance signals from the very architects who built the moat.
They are, in essence, a generational retail compounding machine that currently appears to be priced by the market for a level of perfection they are demonstrably struggling to maintain in the short term.
I think that sums it up perfectly.
So what does this all mean for you as you process this analysis? As we wrap up today, I want to leave you with a philosophical question. Something to mull over that goes far beyond the PE ratios, the gross margins, and the inventory days.
A bigger picture thought.
Right. Consider the very nature of a luxury mechanical watch itself. As we established right at the beginning of this deep dive, it's a device designed to tell time, something our smartphones do flawlessly, effortlessly, and for free in the background of our lives. Yet, human beings are willing to pay millions of rupees for them purely as status symbols, as tangible stores of value, as wearable art.
It remains the ultimate physical manifestation of surplus wealth and societal positioning.
But here is the existential call-in looking forward. As India's wealth continues to formalize and digitize, and as completely tech-native generations, people whose entire social and professional lives have been mediated by high-definition screens and digital networks enter the prime consumer class, will the ultimate definition of status remain tethered to physical Swiss mechanics?
That's the real unknown.
Will the 25-year-old crypto millionaire or the 30-year-old AI startup founder in Bangalore still possess the desire to signal their success using a mechanical gear and spring watch invented 2 centuries ago? Or will the very concept of luxury inevitably evolve into digital realms or purely experiential realms long before Ethos can fully capitalize on its massive, capital-intensive, 80-store physical empire?
It's the defining existential question not just for Ethos, but for the entire global luxury watch industry. Does the physical Veblen good, the heavy gold on the wrist, survive the complete digitization of human status?
We started this deep dive by talking about the absurdity of a mechanical watch in a hyper-digital age. The phone in your pocket tells the time with atomic precision, but the watch. The watch tells the world exactly who you are, or at least who you desperately want them to think you are. The real question for the future of Ethos is simply this: how long will the world keep listening to that specific language? Thank you for taking this journey with us today. Keep questioning the economic world around you, keep looking for the actual mechanics operating behind the corporate curtain, and remember, the best insights almost always come from looking past the sparkling, beautifully lit display case and staring directly at the cold, hard ledger beneath it.